Welcome to Mijon, where we focus on the basics of investing in United States stocks. I'm Mijon from Mijon University. Let's begin today's United States stock market news for July 31st. As always, welcome to Mijon, where we stick to the fundamentals of investing in United States stocks. It's the last day of July. What about July 2025? It went by in the blink of an eye, so fast that I can hardly remember how it passed. Today's broadcast and tomorrow's broadcast on August 1st will probably be the last YouTube broadcasts I send you from the United Kingdom. And after that, since I'll be moving to a new place, I think I'll have to take a break from broadcasting for about 10 days. During that time, since it was a YouTube broadcast, it will be a bit difficult to get information about investing in United States stocks. For those of you who feel this way, besides the free YouTube channel, I also have a paid membership that I run. I think it would be good if you consider joining the Mijuwon All-in-One membership. For those who want to join the Mijuwon All-in-One membership, we're holding a special event where you can get a 50% discount for a limited time. It's until August 3rd, and for those who might find the annual fee a bit burdensome, you can just sign up for a monthly membership for 1 month, so even while I'm taking a break from YouTube, you'll still be able to get investment information and insights. I wanted to suggest this option to you. Personally, I feel really sorry for taking a break from my YouTube channel, and I don't feel comfortable about it. But right now, it's a really difficult time for me to keep broadcasting, recording, editing, and uploading videos like this. I ask for everyone's understanding. Alright, then let's get started with today's Big Two Shin news coming to you on the last day of July. Today as well, I'll start by introducing a few comments left by our valued subscribers. Yesterday on the broadcast, I mentioned that it's been over 5 years since I first bought Nvidia. So actually, Nvidia's stock has gone up about 17 times, but if you look at my portfolio, the return on Nvidia isn't even 200%. So it really feels like I lost out. I've talked about this before, but I think I need to explain it a bit more clearly. I think it still needs a bit more explanation. First of all, someone using the identification Misora said, I've been buying Nevada identification IA for 5 years, and my return is less than 200%. It seems like the returns have dropped a lot. They expressed some concerns like this. And Park Young-mi also said, your son and daughter have grown so much. I think I remember seeing them on Mijuwon YouTube when they were little. I also made over 1000% profit from NVIDIA. I have a question. There was a question about whether it's more profitable to average down by buying more shares and lowering your average price, or if it's better to just hold what you have when the stock price goes up. In other words, is it better to buy more or just keep holding? I don't think I explained it well enough yesterday. So I'll briefly show you something from a book I found last year called The Principles of Investing in United States Stocks. Now let's assume we bought 10 shares of Nvidia stock, and let's say we were lucky and bought those 10 shares at $100 each. That means our investment amount is $1,000. Now let's assume that after we bought it, Nvidia's stock price doubled. Then, as the $1,000 grows to $2,000, our return becomes 100%. Now, after making a 100% profit like this, let's take a quick look. Nvidia's growth is extraordinary. So it looks like the stock price will continue to rise steadily in the future, right? Then I should boldly buy more shares. So as you can see here, I bought an additional 10 shares. What does that mean? You have to pay $200 per share, right? Because the stock price that used to be $100 has now doubled, so you have to pay $200 to buy it now. What that means is you need to pay $2,000 to buy 10 more shares, and the current value would be $2,000. Now, at this point, what we shouldn't get confused about is this. If you add 10 more shares like this, our actual total return rate suddenly drops from 100% to 33.3%. So, since my return rate dropped from 100% to 33%, it really feels like I'm losing out. But that's not the right perspective. Because the first 10 shares I bought still have a 100% return, and the newly purchased shares just start at 0%. So if NVIDIA stock goes up another 10% from here, that means the return that was 100% will go up to 110%, and the additional shares you bought will go up to 10%. That's how you should look at it. So the 33.3% shown here doesn't mean anything. That's why I've often told you that you don't need to pay attention to the return rates for each stock shown in your stock app. Now, the opposite case is the same. If you look down here, I'll use Tesla stock as an example to explain. Tesla is the sole stock among the Mejon topics that has yielded a negative return year to date. So let's assume we bought 10 shares. When we bought the 10 shares, the price was $100 per share. That means we bought 10 shares for $1,000. But unfortunately, let's say it dropped by 30%. In that case, the amount we invested was $1,000, but it fell to $700, so now we're seeing a 30% negative return. But here, this is where we usually average down. So to improve our return a bit, there are times when we buy 10 more shares. When that happens, the 30% loss suddenly drops to minus 17.65%, and then you start to feel better. Now my Tesla return has improved from minus 30% to minus 17%. Well, it's not bad. You start to feel a bit satisfied with yourself like this, but there's a problem with this. Because as you can see here, the 10 shares I just bought are starting fresh at 0%, but the 10 shares I had in the past are still at minus 30%. Even though we bought the same stock, these are actually two different investments. So you shouldn't mix them together and see it as 17.65%. One should be seen as minus 30% and the other as 0%. Now, let's assume we have a huge amount of capital, and instead of investing in stocks, we invest in real estate. Let's say we bought an apartment in Gangnam, and its price went up significantly. We then decide to buy another one in Gangnam, but at that point we don't combine the two together. One is an apartment that went up by 100%. The price of a newly purchased apartment or stock is calculated from the point of purchase onward. This is how you determine if the value has increased or decreased since the acquisition. I wanted to make this clear for you. And I'd like to add one more thing since we're talking about apartments. Let's say we bought one apartment in Seoul and another one in a different region. The price of the apartment in Seoul went up a lot, but the price of the apartment in the other region went down. Now, if we suddenly had enough money to buy one more apartment, would you buy another one in Seoul, or would you buy another one in the other region? In my case, since the price in Seoul keeps going up and the price of the apartment in the other region keeps going down, I would definitely buy another one in Seoul. Surprisingly, stock investors often do the opposite of real estate investors. They sell stocks that have increased in value and buy more of those that have decreased. So this is exactly why Korean investors who are really good at real estate investing strangely end up losing money when they invest in United States stocks. You have to follow the same rules. That's how I'll wrap this up. Today, I'll also summarize yesterday's United States stock market. First, let's look at the S&P 500 map. Yesterday was also a down market. There is some green though. It can be found here and there, but it's very rare. So overall, it's correct to say that the entire market went down. Nevertheless, Mijun family members probably felt that the stock market wasn't too bad, because except for about 5 stocks, all of the Mijun top picks went up. So, artificial intelligence beneficiary stocks generally performed well. In a way, it was a somewhat unbalanced market, and that's how we can sum it up. If you actually look at the movement of the major indices yesterday, only the Nasdaq 100 was in the plus, while all the others were in the minus. The S&P 500 was also down 0.13%, and the Dow Jones fell 0.39%. So overall, the market sentiment wasn't good. Only semiconductor and artificial intelligence beneficiary stocks were in a good mood, you could say. And this phenomenon, in fact, wasn't all that positive. Stock prices were okay, but the problem is that the market breadth keeps narrowing. At one point, the market breadth was close to 80, which was very wide. But now, as you can see, it's shrunk to 60 and even 23. What that means is, among the 500 companies listed in the S&P 500 right now, if there are 10 stocks, only 6 of them are doing well, while the other 4 are not performing as well. So, as the market breadth keeps narrowing, there was a sense of concern that a correction might happen soon. That's how you can look at it. Now, there was a reason why the market sentiment wasn't very good. Yesterday, after the Federal Open Market Committee meeting ended, there was finally a statement from the Federal Reserve and a press conference by Chairman Powell. After the press conference ended, the stock market trend wasn't very good. Now, let's take a look at what Chairman Powell actually said during the press conference, one by one. Jerome Powell is the chairman of the Federal Reserve, which we often call the Fed. On Wednesday, the chairman of the Fed attended the Federal Open Market Committee, which we refer to as the Federal Open Market Committee. So, the Federal Open Market Committee decided to keep the benchmark interest rate unchanged at 4.25% to 4.5%. We all anticipated this. Few expected the interest rate to be lowered this time. Now, despite the increased uncertainty, the economy remains strong. He made some positive remarks, indicating no immediate concerns about the economy. But now this is good news, but people are interpreting it as bad news. Because there are a lot of people asking for interest rates to be lowered, but it feels like they're not going to lower them. That's because if the economy is strong, there's no need to lower the interest rates. All right, let's keep reading. The labor market is still strong and inflation is still somewhat high. So right now, the Fed has two tasks. One is to support the labor market and the other is to control inflation. But out of those two tasks, the labor market is fine right now. So we don't need to worry about that. But the problem is, inflation remains high and is currently the more pressing issue of the two, according to what is being said. Chairman Powell said that monetary policy is in a good position to respond to economic changes in a timely manner, and regarding the actions at the September Federal Open Market Committee meeting, he mentioned that nothing has been decided yet. Now, this is the reason why the stock market didn't perform well this time. Many investors were hoping for at least a hint. So, there was no chance of a rate cut in July, but at least by September, people expected there might be a cut, or at least some mention of the possibility, even if it wasn't certain. There was hope for that, but those expectations were let down. Chairman Powell, he said that while service prices continue to ease, high tariffs are pushing up the prices of some goods. The overall impact of high tariffs on goods inflation still remains to be seen. He said, due to tariffs, prices may increase, but for now it's uncertain, so he'll wait before taking action. The Federal Reserve said it cannot yet determine whether the impact of tariffs will be short-term or more persistent. They're saying they'll keep watching for now. He said that a moderately tight policy seems appropriate at the moment. The Fed's benchmark interest rates are currently very high, but he stated that it's acceptable as it's only moderately tight and not excessively high. And he also said that the current interest rates don't seem to be excessively restraining the economy, so they have no plans to lower rates for a while. He was saying this in a roundabout way. Now, let's take a look at what important things were said at each point in time. He said this at 2:47 post-meridian. It will take time to assess the impact of tariffs on prices. Since the tariffs were raised recently, he said we need to wait longer and can't hastily lower interest rates. So far, most of the tariffs have been absorbed by companies and retailers. When tariffs are imposed, prices go up. But instead of passing these higher prices on to consumers, companies and retailers have absorbed the cost themselves. However, we are starting to see tariffs show up in consumer prices, and we expect this trend to continue in the future. That means as prices keep rising, there's a high possibility that inflation will increase. You could also say that by not raising interest rates, he is overlooking commodity inflation. He said something terrible. So far, we've only talked about interest rate cuts and there hasn't been much talk about raising rates. But now Chairman Powell could be criticized for overlooking the current commodity inflation if he doesn't raise interest rates. That's what was said. But then he eased up a little bit. There is a good argument that tariffs are a one-time price increase and will not lead to sustained inflation, which supports the basic scenario. So right now, the Fed expects prices to rise due to tariffs, but they believe this is a one-time effect and will not lead to sustained inflation. There is a good argument to support this opinion. Since it's logically supported, they reassured us not to worry. So now, according to the Chicago Mercantile Exchange FedWatch tool, traders are reducing their bets on a rate cut in September. The probability of a rate cut in September was 63.3% yesterday, but it dropped to 56.1% in just one day. If the current trend continues, a rate cut in September seems unlikely, and many are abandoning that expectation. Alright, and also, Federal Reserve Chairman said that the Fed is trying to time the adjustment of its monetary policy, Because if they cut rates too soon, inflation could come back, and if they cut too late, it could cause unnecessary harm to the labor market. We're trying to handle both issues, so please trust us a little. That's what he said. He stated that despite a decline in private sector job growth, unemployment remains low. He said that although labor demand has decreased, supply has also gone down, so the market is balanced and there are no problems in the labor market right now. Looking at the entire labor market, it's balanced, but there are downside risks. So if the labor market cools down a bit, that's when he will take action. That's what he said. Chairman Powell also said that gross domestic product fluctuates a lot from quarter to quarter and is often revised. So he's saying there's no need to pay attention to the gross domestic product announced yesterday. Labor market data is the best data we get about the economy. The key focus is on the upcoming Friday's employment report and the unemployment rate, according to the speaker. And in my view, the labor market is still quite solid. So to reiterate the two main points, inflation still seems a bit more risky, and the labor market is still healthy. That's how I can sum it up for you. Let's hear Mijun's closing remarks. What about the statement released by the Fed yesterday and Chairman Powell's press conference? They didn't give investors any signal about a rate cut in September that everyone was waiting for. That's why stock prices surged, then suddenly dropped. But even so, personally, I want to positively evaluate Chairman Powell's stance of not rushing to cut interest rates. Because the current interest rate level is keeping the United States economy in a Goldilocks state, neither overheating nor cooling down too much. The main storyline of the interest rate cut cycle is being maintained. We are not in a rate hike cycle, but rather in one where rates are coming down. The big picture of this interest rate cut cycle remains intact. By gradually reducing the rate cut pace, they aim to prolong the Goldilocks period maximally. In the end, my personal judgment is that this isn't bad for the United States stock market. So there are two cycles, a cycle where interest rates go up and a cycle where interest rates go down. The cycle we want is the one where interest rates keep going down. So rather than how quickly interest rates drop, what's more important is how long we stay in a period where interest rates are falling. If you look at the successful soft landing case of the Federal Reserve from 1995 to 1996, the policy interest rate was also very high at that time. They lowered the policy rate, which had reached 6% down to 5.25%. They lowered it little by little over a long period of time. And another thing is 5.25% is much higher than it is now. Now, even though they maintained such a high interest rate, the United States economy grew during this period without a recession. It was a small amount, but it was positive growth, not negative. If they succeed in achieving a soft landing like this, we call it a soft landing. The S&P 500 saw annual growth rates of 34% in 1995 and 20% in 1996. Now, as we know, the average annual return of the United States stock market is about 10%. Now, even though the interest rate was as high as 5.25%, if the economy still maintains very good conditions, there have been cases where the market went up 34% one year and then 20% the next year in a row like this. Therefore, we can infer that a soft landing and the interest rate cut cycle are important. And on the other hand, if the Fed rushes to cut interest rates, the market might interpret it negatively, thinking it means something bad will happen if they don't lower rates quickly. The market may interpret this as a sign of a faster than expected recession. What we know at this point is that an interest rate cut will eventually come, so we can have that expectation. Yesterday, I talked about two conditions for happiness. One is that today is better than yesterday, and the other is the hope that tomorrow will be better than today. If we have this hope, we can be happy. It's the same for the stock market. If the situation today is better than yesterday, and you think tomorrow will be even better than today, then there's a good chance the rally will continue. So, while it's important that interest rates are rising, what's even more important is the timing, the speed, and the reasons behind it. Now, when it comes to lowering interest rates, how quickly they are lowered matters. A slower pace is better. That's because there are two reasons for lowering interest rates. The first is to stimulate the economy when it's in a recession. The other reason is disinflation. If there's no longer any concern about inflation, and people believe that lowering interest rates won't cause inflation anymore, then they'll decide to lower the rates. So it's important to remember whether interest rates are being lowered because of disinflation or because of an economic recession. That's what really matters. Now, I'm talking about this prolonged interest rate cycle. In the end, this allows for a healthier rally in the market, so the bear market becomes more and more distant. That's how you can interpret it. So in the end, when it comes to stock investing, it's important to remember that the most ideal situation is when things keep getting better, even if only little by little. Just earlier, I explained that it's actually positive that the Fed chair isn't rushing to cut interest rates. But many investors participating in the market don't seem to be very pleased with Chairman Powell not giving in to President Trump's pressure. That's why most sectors showed negative returns yesterday. Now, if you look at the futures index, the situation has suddenly changed. The Dow Jones is up 0.4%, 0% S&P 500 futures are up 1.03%, and Nasdaq futures are showing a sharp rise of 1.34%. So, you must be wondering why the mood for United States stocks has suddenly improved like this. There are two reasons for this. First, starting with the smaller news, there's some welcome news that the Trump administration has reached a 15% tariff trade agreement with Korea. Now with this, last Friday, an agreement was reached with Japan, then the day before yesterday with the European Union, and now with Korea. Now, with this, really, Trump's tariffs are becoming more and more visible. The uncertainty is decreasing now, isn't it? And instead of the previous high tariffs, like 20% or 25%, which sometimes even went over 30%, now it ends at a more reasonable level, like 15% or 20%. You could say that people are breathing a sigh of relief now. But there was an even more important reason than this. Yesterday, there were two huge earnings results. The first one is Microsoft. After the earnings announcement, the stock price surged by as much as 8.33%. The second one is Meta, which I am quite fond of. Meta's stock price surged 11.74% following the earnings announcement, displaying a strong upward trajectory. I mean, just how good were the earnings results? I think I need to start by explaining how a company as big as Meta, one of the largest in the world, can have its stock price soar by nearly 12% like this. And this earnings report was extremely important. I mentioned this last week, but the earnings results of companies like Meta, Google, Amazon, and Microsoft are very important indicators that determine the stock prices of artificial intelligence beneficiary stocks we care about. So, the fact that Meta announced a blockbuster earnings report means that the stocks of companies we like, such as Nvidia, Advanced Micro Devices, and Broadcom, could also rise. That's how you should see it. Now, let's take a closer look at Meta's blockbuster earnings results. First, let's take a look at the revenue. They generated about $47.52 billion, which is equivalent to $47,520 million. The problem is the year-over-year growth rate is 22%. Recently, it's almost unprecedented for Meta to show growth of over 20%. That's incredible. It's not like they're just a small shop or anything. For one of the biggest companies in the world to increase its revenue by 22% is no ordinary feat. Operating expenses increased by 12%, while revenue grew by 22%, showing a lower expense growth compared to revenue. What does that mean? The margins must have improved a lot. Here it is. Operating profit rose 38% with the operating margin now at 43%, up from 38% last year. A 38% margin is already impressive, but 43% means 430,000 won of every million won earned is profit. They're exhibiting remarkable performance with impressive net profit. It increased by 36%, and the earnings per share also went up by 38%. Now, when the earnings per share goes up by 38% like this, the stock price can rise by 38% with the same valuation, as the price equals earnings multiplied by the multiple. That's what I mentioned. That's why Meta's stock price saw such a huge increase yesterday. You can look at it that way. Now, if you look at the analysts' consensus estimates, there's one more thing. For revenue, they were expecting $44.8 billion. They were expecting $44.8 billion, but now they've made $47.5 billion. That's a huge difference. The earnings per share is approximately $5.88 to $5.89. They expected even $6 to be difficult, but it easily surpassed $7. Let me briefly explain what this means. Now, in just one quarter, they made $7.14. $7.14. And even if we assume there won't be any progress in the coming quarters, if you multiply that by 4, You get the earnings per share for a year. So even if there's almost no progress, if they just make as much as they did this quarter for the next 3 quarters, the earnings per share that Meta is expected to generate over the next year it's almost $29. So let's put down $29. The multiple is about 26 or 27 times these days, right? So let's multiply it by 27. Then Meta's stock price should be about $783 right now. But yesterday Meta's stock price was $695. That's why this became a trigger for the stock price to suddenly surge. You can calculate it like this. Let's continue to take a look at what kind of earnings were announced. Next is daily active people. Daily active people stands for daily active people. It's the number of people who come in every day and use Meta's apps. On average, 3.48 billion people use Meta's platforms every day. The world population is 8.2 billion, right? That means 42% of the world's population. You can see it as 42% of people coming in every day and using at least one app like Instagram or Facebook. Notably, it grew by 6% compared to the prior year. No one really expects that people will use Facebook or Instagram more today than they did yesterday. This app, already widely used, experienced an incredible, explosive 6% user growth compared to the previous year. Now, the number of ad impressions also increased by 11%, and the price per ad went up by 9%. So people are seeing more and more ads. Additionally, the price per ad is increasing by 9%, nearly 10%. So it's only natural that revenue increased. You can see it that way. Now, next is the operating cash flow margin. As you can see, it's 53.8%. If you earn 1 million won after essential expenses, you'll have 538,000 won in disposable income. That's an incredible margin. And if you look below, there's the free cash flow margin. The difference between these two is that the free cash flow margin, after spending everything, including capex, like recently, Meta has been investing a huge amount of money to buy GPUs and for artificial intelligence investments. After subtracting all that, what's left is 18%. The company's capital expenditures reached an impressive $17.01 billion over a 3-month period, as shown in the provided figure. They spent $1.7 billion. Despite this, their strong operating cash flow leaves them with $8.5 billion remaining after subtracting $17.01 from $25.56. With strong operating cash flow, they repurchased 9.76 billion of their own shares and paid out $1.33 billion in dividends. Now, since their performance was so good, it's also important to look at their outlook, right? They provided a revenue forecast of 47.5 to 50.5 billion, so they're saying that the third quarter will be better than the second quarter. Of course, that's for the fourth quarter as well. They said that due to the base effect, the growth rate might slow down a bit, so it's not possible to keep increasing by 20% continuously. Now, costs are important. That's because, as I mentioned earlier, how much money Meta spends determines the stock prices of the artificial intelligence beneficiary companies we care about. Just look at 2 things. For 2025, capex has been revised upward from 64 billion to 72 billion. They're basically saying they'll spend much more than what we originally calculated they would. And not just in 2025, but the cost increase rate in 2026 will surpass that of 2025. So this year, we'll have to spend more than we thought. And next year, the cost will actually increase even more than this year. This doesn't mean we'll spend more money itself, but that the rate of cost increase will be higher. Over time, the cost increase will become steeper. That's what I'm saying. We can say that this gives us a huge hint, and as we all know, Meta is... Right now, they're pouring a huge amount of money into securing talent. They're recruiting a large number of key artificial intelligence personnel from Apple, Open Artificial Intelligence, GitHub, and so on. They announced it proudly. Zuckerberg's goal is shown right here. It's to develop personalized superintelligence. So it's not just about running artificial intelligence in apps to increase revenue. Our company's motto is to create personalized superintelligence. We're saying that we will become the #1 company. So personally, I would like to say that it was a jaw-droppingly perfect earnings performance. Now, I'd like to add just one more thing and explain it a bit. Yesterday, Mark Zuckerberg confirmed something very important. If you scroll down here, you'll see what Zuckerberg said. Our Prometheus cluster is scheduled to be operational next year. What this refers to is the new data center we're building. Now, it's going to be the world's first gigawatt class or higher cluster. So why are we suddenly talking about gigawatts here? The size of a data center is usually measured by its power capacity. So the greater the power capacity, the larger the data center. You can think of it that way. Now, we're also building a new data center called Hyperion. This could be expanded up to 5 gigawatts over several years. He confirmed this once again. Now, I'd like to explain just how much capacity 5 gigawatts actually is. First, let's compare it to a nuclear power plant. Generally, as you know, there are nuclear power plants in Korea. The power generation capacity of one nuclear power plant is about 1 gigawatt. But what's shown here is that Hyperion is 5 gigawatts. That equates to the power of 5 nuclear plants, which is still difficult to comprehend despite the explanation. But if you look below, it says that 5 gigawatts is about the same as, or even exceeds, the maximum power demand of the entire Seoul metropolitan area, or major global cities like New York or London. In terms of households, 5 gigawatts is an enormous amount of power that can supply electricity to 3.75 million to nearly 5 million households at the same time. But what they're saying is that we are going to build Hyperion, which can handle this enormous amount of power, and right now, the largest data center in the world has a final target power capacity of 650 megawatts, which is only 0.65 gigawatts. So, the Prometheus cluster by Meta, which will be operational starting next year, is said to be over 1 gigawatt. So just with this, it's already surpassing the world's largest existing data center. Not only will it surpass it, but it will be almost twice as large. That's how you should see it. Now, the ultimate goal is Hyperion, and that's 5 gigawatts. A 5 gigawatt data center aims for a power capacity that's about 7 to 8 times larger than the largest existing data center. That means it will also have 7 to 8 times more GPUs than the largest data center on Earth right now. That's what it means. Nvidia stock, which has risen 17 times over the past 5 years, still doesn't seem necessary to sell yet. Going forward, as more and more data centers are built and their scale continues to grow, therefore Nvidia GPUs will not only continue to sell well, but this growth trend will never quiet down or slow down. That's my personal assessment. So, as we just saw, how are the United States stock futures doing right now? They're running strong, but it's still uncertain how long this atmosphere will last. Because this week and next week, there are a lot of major catalysts coming up. Once again, momentum tends to last for a while, but the problem is, when it meets a catalyst, the angle changes. It could get steeper, or it could be adjusted downward. So having a lot of catalysts always makes investors nervous. Even today, after the market closes, Apple will announce its earnings. And that's not all. Amazon, First Solar, Coinbase, and MicroStrategy, these are all popular stocks among the United States' top picks, and many of them are announcing their earnings. So, depending on the earnings results, the mood could change a bit, or it could even get better. Now, at 8:30 in the morning, a crucial economic indicator will be released, the core personal consumption expenditures inflation data for June. The Federal Reserve is still very concerned about inflation. So, if the personal consumption expenditures shows another good number, the Federal Reserve might start to think that inflation is really coming under control. Therefore, we need to pay attention to the personal consumption expenditures results that will be announced today. Now, there are still a lot of major earnings results coming up next week. Palantir, which I introduced on yesterday's broadcast, and Advanced Micro Devices will also be announcing their earnings. Personally, I have high expectations for Advanced Micro Devices' earnings. The reason is that, like NVIDIA, Advanced Micro Devices is also opening up exports to China. Therefore, there is a high possibility that guidance and various other factors will be revised upward. Personally, I'm looking forward to it. So what's the last content we've prepared for today? We'll also listen to an unofficial podcast, specifically one about Advanced Micro Devices' earnings outlook. That's it for our last broadcast of July. I sincerely thank everyone who joined us with Mijuan in July 2025. I'll greet you again tomorrow, August 1st, in my last broadcast from the United Kingdom. Let's all keep fighting together until the day we all retire through investing in United States stocks. Have a happy day, thank you.
Hello, Ms. Home family. I'm back with another interesting article. Today's hot economic issue is the highly anticipated Advanced Micro Devices earnings announcement coming up on August 5th. The artificial intelligence chip war is really heating up these days. So everyone is really focused on whether Advanced Micro Devices can once again achieve a double beat, surpassing market expectations for both revenue and earnings. Today, based on an analysis article from Seeking Alpha, we're going to take a deep dive into Advanced Micro Devices' current artificial intelligence momentum, its earnings outlook, and even potential risk factors. We'll highlight only the key points that you're most curious about.
Hello? Last quarter's performance was really impressive. Both revenue and profit far exceeded expectations, and the growth in the data center sector was especially remarkable. So, the biggest question is whether they can continue that strong momentum this time as well. That's right.
In Q1, both revenue and profit significantly exceeded expectations, which was remarkable. Data center revenue grew 57% year-over-year, accounting for nearly half of total revenue. This demonstrates that Advanced Micro Devices is cementing its position as a major player in the artificial intelligence era, which we should view as a strong signal. The overall profit margin was also solid at 54%.
The data center sector saw explosive growth. The main reason was reportedly the substantial growth in adoption of advanced micro devices, is ePYC CPUs and Instinct GPUs. In the end, all these trends are directly connected to the increase in artificial intelligence demand. I'm curious about what specific moves have been made.
Yes, that's correct. The key point is that the demand for the artificial intelligence 300 series GPUs is steadily expanding. Recently, they also announced a huge deal with Oracle, building a cluster using 30,000 i35X GPUs, and I heard it's worth several $billions. On top of that, they've already started sampling the next generation MI 3350 series chips, and the MI 400 series is also set to launch soon. This really shows their determination to target the massive artificial intelligence computing market, which is estimated to be worth over $500 billion. It's very aggressive. Oh, and recently they acquired the artificial intelligence infrastructure company GT System. This also signals that they're not just selling chips anymore, but are strengthening their capabilities to provide integrated solutions as well.
Wow, they're really moving fast in the artificial intelligence field, aren't they? But is there anything we should be concerned about? For example, issues like the export restrictions to China. How is that going?
That's a really important point. There were concerns that there could be an annual sales loss of about $1 billion, right? But recently, we've heard some good news. There was news that the United States has resumed reviewing duplicate export licenses for the MI 308X chip.
Oh, really? Then if it gets approved,
If approved and exports resume, analysts predict a short-term sales increase of $700 million and up to $1.5 billion in the long term. That's the kind of analysis I've seen. And what's interesting is that the current market earnings per share forecast is a bit low, but this could actually lead to a surprise performance in the next earnings announcement. So there's also the perspective that this could serve as a lower hurdle to create a surprise, If you look at the quarterly guidance that Advanced Micro Devices released, they're expecting sales of around $7.4 billion, give or take $300 million, and a gross margin of about 54%. But you have to keep in mind that the market consensus is already set at the upper end of that guidance. However, since Advanced Micro Devices has often exceeded its guidance in the past, people are speculating that there's a possibility of a double beat this time as well.
There are many positive factors, but what do people think about the current stock price or valuation? Isn't it a bit high?
Yes, let me explain that analysis and perspective. It's called forward P. The stock price level compared to the expected future earnings is about in the mid-teens, so just looking at the numbers, it might seem a bit high. But compared to Advanced Micro Devices' stock price history, it's actually at a lower level, and especially since the proportion of data centers keeps increasing and margins are expected to improve, analysts believe that the current premium can be fully maintained. They set the 2026 target stock price at around $223 and maintained a buy recommendation, downgraded from a previous strong buy rating. Target?
If the stock price is $223, that's quite a bit higher than it is now. They're saying there's about 34% upside potential.
Of course, we also need to clearly consider the risk factors. The biggest risk is definitely the competitors. The competition with NVIDIA is expected to get even more intense.
If NVIDIA really starts a price war, Advanced Micro Devices' margins and valuation premium could take a hit. And another thing is that market expectations are extremely high. So if Advanced Micro Devices' earnings only meet the midpoint of their guidance, the market might see that as an earnings miss and the stock price could drop sharply. That's right.
If expectations are too high, that's also a burden. And recently, Intel's performance was a bit disappointing, and that could also be a bit of a burden on investor sentiment. There are definitely a lot of things to look forward to, but at the same time, there are certainly some concerns as well. While there are strong growth drivers, there are also significant risk factors that can't be ignored. It seems necessary to approach this cautiously.
Analysts also advise that if you're a cautious investor, it can be a good strategy to wait and see the actual earnings announcement and how the market reacts afterward before making an investment decision. So to sum up today's discussion, Advanced Micro Devices has very strong artificial intelligence momentum, growing demand for data centers, and even the possibility of eased export restrictions to China, so expectations for this quarter's earnings are quite high. At the same time, there are definitely burdens such as the market's high expectations and the fierce competition with Nvidia.
Yes, I think today's analysis allowed us to look at Advanced Micro Devices' current situation from several different angles. The soon-to-be-announced actual results are drawing even more attention. I'm very curious.
We hope that the Advanced Micro Devices analysis we explored together today has provided you with some useful information for your investment decisions. Lastly, I'd like to ask this question. If Advanced Micro Devices once again show strong growth that exceeds market expectations this quarter, how will the landscape of the artificial intelligence semiconductor market change in the future? I hope you'll take a moment to think about it.
We'll be back next time with even more interesting and useful information. Thank you for joining us.
The beginning of any dream is important, so let go of your greed and grow little by little every day. Enjoy today's journey. Even if adjustments come in the darkness, I'm not afraid. Retire with United States stocks.